Markets Now is brought to you by the 5-year anniversary of Brevant Seeds. Here's to 5 years of not just winning, but collecting one game-changing W after another. See all of our wins at brevant.com/wins.
And welcome to Markets Now. I'm Michelle Rourke with Darin Newsom, Senior Market Analyst with Barchart. Seeing a lot of red on the board in grain and livestock futures trade this morning. And Darin, I want to start off talking about soybeans. We had a big 3-day rally, 65 cents of gains. Are we just seeing some profit taking, you think, here? Did we run up into some chart resistance?
I would like to think, well, number one, I don't know the technicals really have anything to do with markets these days. But my blink reaction to this is, it's the reality of, real fundamentals are sinking back in. We've seen soybeans spiked by, I'll be nice and just say a social media post on Monday or early Monday morning, and then that was followed up by this past Wednesday's USDA imaginary numbers with some very interesting figures for the soybean that really, test the limits of someone's imagination. But it is what it is. So the design was, the intention was for both of those events was to trigger algorithm buying, and that's what happened. And so now here we are on Thursday morning. The buy orders have been filled. Market was pushed higher. Didn't really change anything on the charts, didn't really change anything, and it certainly didn't change anything fundamentally. And so Thursday morning, a little bit of a vacuum underneath these things, starting to sink lower again as we head towards the next weekend. And the focus will be back on weather and crop still looks good. And what future spreads have been telling us all along, that the U.S. is going to produce more soybeans than what it has demand for, and that's the bottom line.
Yeah, especially if we don't get China back in the market. And it looks like we've kicked the can down the road again here, huh?
Yeah, again, this gets so much attention, but China's not going to be back in the market. There were two stories out Monday from the same media company. The first one that came out around midnight talked about, just basically reiterated what we've known since 2018, that Chinese buyers have done the math to basically deal the U.S. out of the global soybean game. That hasn't changed. And the only thing is the situation continues to go down that same path. And China has a long-term view of anything that is called war. They take a long-term approach. The U.S. has an attention span of 15 minutes. And so, 4 hours later the story came out, same media group, of what the U.S. president posted to social media. Now, I understand that in the last decade, social media has become official policy. It doesn't have to go through Congress, doesn't have to go through, what the channels that we used to think were in place, checks and balances and so on. It's what is posted to social media. But the reality is, again, and we can see in the futures, we can see in the spreads, we can see in the market in general, supply and demand situation hasn't changed. China's not going to buy unless there is some sort of weather problem in Brazil. Then maybe that increases the attractiveness of U.S. markets. But until then, I just don't see it changing.
Yeah. We also had cancellations of old crop soybean exports. We had cancellations of old crop corn exports. So corn right now, new crop looks pretty good. But overall, do you think that is demand even good enough to chew through as big a crop as we have on corn?
Well, let's look at what's happened in calculated full commercial carry. Both corn and soybean new crop spreads, new crop forward curves saw the percent of calculated full commercial carry increase during July and through the early part of August. That tells us right there that demand is not expected demand by the commercial side, not necessarily by the fund side. They just simply follow what the fundamentals, they'll eventually follow the fundamentals. But on the commercial side, those that actually matter, those who are, say, exporters or end users or large terminals or so on, the opinion is that expected supplies continue to gain on projected demand. And that's what we see in both markets. So it doesn't matter if USDA comes out and says, US is going to produce 18 billion bushels or whatever it was of corn and 5 billion or 3 billion bushels of soybeans, whatever the numbers were, I don't even know. The bottom line is there's going to be more supplies in relation to demand. And that hasn't changed. So no, demand is not keeping up. The fact that we got some cancellations through the first part of August isn't overly surprising. We're into the last month of the marketing year for corn and soybeans. And if it hasn't been shipped by now, it's probably not going to be, which makes USDA's move to increase both, in its latest guesses, increase export demand, old crop export demand for both corn and soybeans, that much more humorous.
Weather obviously has been bearish for this market, and I can't remember in August where we've had better weather, at least to start off with.
Yeah, this has been incredible, across the plains, across the Midwest. And, love them or hate them, for what they're worth. U.S. Drought Monitor comes out every week, every Thursday morning. And this time around, again, similar to last week, we just don't, you just don't see any hot spots really across all of the plains, from the northern border of North Dakota all the way down to the southwest border of Texas. There's a little bit in the far southwest edge of Texas, but you take it all the way across the Midwest over into Indiana, Ohio, and so on, and there just aren't any problem areas. So weather has been as close to ideal this time around, at a time when the U.S. probably needed some weather problems. But again, we can see in the market that, again, the commercial side just isn't overly concerned about, what people still make up, still, try to get people to trade these make-believe weather issues or growing issues that the crops just simply haven't had this year.
Right. And the funds haven't had any weather threats to buy on either. But let's also talk a little bit about, we had CPI numbers out earlier last week. Actually, they look fairly favorable, but PPI was out this morning, 0.9%. That was well above expectations. Does this take a rate cut in September off the table for the Fed?
I think it's an interesting discussion. I know there's there's dictates out there that says, the Fed is going to have to cut rates. But the market isn't showing us that. If we continue as we watch the Fed fund futures forward curve, we saw that it was about a 50-50 chance that we would see a rate cut at the September meeting. And this continues to get pushed back for, each month, almost, as we approach the next meeting. And so really the meeting that's been in the spotlight for the last number of months has been the October get together by the Federal Open Market Committee. So do I think that the CPI and PPI numbers, I know the economists watch this closely, but the markets certainly didn't believe that we were going to see a cut. And I would still argue that there's a better chance for a rate hike before we get the next cut. Now, I'm kind of going on a limb. I always talk about how I watch the market and let the market dictate my actions and these sorts of things. And the market certainly isn't indicating right now that we're going to see a rate hike, except for the fact that the US dollar technically turned bullish at the end of July. But again, can we believe what we see on charts anymore? I don't think so. So for now, I'm just going to stay on the sideline and say we're not going to see a rate cut, at least from what I'm seeing in the markets at the September meeting.
Well, we're still not seeing the inflation show up in all of the data yet. I mean, there's a little bit of a lag effect from these tariffs. When does that show up here, Darin?
Again, these are government numbers. And similar to the way USDA can change planted acres by 2, 3, 4 million, whatever it was. Government inflation numbers don't necessarily have to be grounded in reality. Everyone that I hear from who goes to the store, and it doesn't matter if we're talking about a grocery store, retail store, implement dealer, tractor supply, whatever, prices are high. Inflation is real. We have seen increased inflation. The tariffs, the constant threat of tariffs and the ongoing trade wars have had an effect. They've continued to have an effect. This is what sparked the inflation, the initial flames of inflation between 2016 and 2018, and they've only gotten worse. So inflation is here. And this is one of the reasons why I believe the Fed's still going to have to, possibly raise rates before they cut rates, because that's the defense against inflation, and that is to raise rates to hopefully strengthen the underlying currency, something that the U.S. needs to see at this point.
Yeah. So with what you just said and the fact that the stock market has continued to crack out new highs, does that keep the funds away from the grain market? Stock market still looks more attractive investment wise, doesn't it?
It does for now. Yes. I mean, markets that go to new highs, have a hard time being considered bearish. And we've seen new all-time highs posted in the S&P 500 and Nasdaq here in, through the midpoint of August. S&P, excuse me, the Dow Jones, not yet, but as you and I were talking about beforehand, the Dow Jones is our grandparents, I should say, stock index. More attention's now being paid to the S&P and Nasdaq, as it should be. So yes, and this comes down to the discussion of funds need a fundamental reason to get interested in the commodity sector. Because again, this is where they can look for supply and demand. They can trade the weather. They can trade, global crises and these sorts of things. So outside of gold being a safe haven market and crude oil just fluctuating down near its lows in the low 60s, there's no fundamental reason for funds to get interested in the grains sector in general, particularly looking at the big three markets of corn, soybeans, and wheat. Until that changes, I mean, why go into grains when you've got the livestock sector sitting over in there, a red hot cattle market? Cash continues to go higher, continuing to tell us that supply and demand is way out of line in favor of demand over supply. So if funds are going to move anywhere into commodities at this point, it's going to be into the livestock sector. There's no fundamental reason for them to be interested in grains. Stock markets are doing well. Livestock are hot. There's so many other markets that provide a better opportunity.
No, not a good outlook for sure. All right. Thanks so much, Darin Newsom, Senior Market Analyst with Barchart. That is Markets Now.
When you choose Brevant Seeds, you don't just win. You win so big, the very ground beneath your feet cries tears of joy. You win so big that second place feels like a participation trophy. You win so big, you might as well be harvesting buried treasure. Oh, sorry, just one more. When you choose Brevant Seeds, you don't just win. You hit the damn jackpot. Don't just win. Talk with your retailer or visit Brevant.com/jackpot to get started.